Somewhere in America, right now, two roommates are at war. The battlefield, a kitchen, the weapon, a tower of dishes nobody will admit to. And the question that has haunted shared living since the dawn of the security deposit. Whose turn was it to do them 3 turns ago? Enter Roommate Arbitration Services, the company that settles the unsettleable. Dishes, thermostats, and the mystery leftover that's been in the fridge since a season finale nobody remembers. But before this company can balance your household, it has to balance its own books. So grab a gavel. Today, we're auditing the arbitrators. Meet the arbitrator. 20 years on the bench of shared living. He has ruled on unwashed pans, thermostat treason, and one leftover so old it nearly filed for tenants' rights. But today he isn't judging roommates. Today he's judging his own company's finances. And it all starts with one unbreakable rule: the accounting equation. Assets equal liabilities plus stockholders' equity. Everything a company owns equals everything it owes, plus whatever's left over for the owners. Get comfortable with it, because it holds true through every single case today. Here's how it looks for Roommate Arbitration Services. On the left, assets, everything the company owns or controls. Current assets are what you'll use up or turn into cash within a year. Cash from retainer fees, short-term investments, accounts receivable from roommates who swear they'll Venmo you, supplies like gavels and whistles and passive-aggressive sticky notes and prepaid expenses, insurance for the mediations that turn physical, then the long-haul assets, the land and buildings of neutral territory headquarters, equipment like the soundproof cooling-off chamber, and intangible assets, the trademark on the algorithm that finally answers whose turn it was 3 turns ago. On the right side, 2 claims on all that stuff. Liabilities, what the company owes, money due to the whistle supplier, wages owed to the arbitrators, and conflict credits, retainers customers paid for disputes not yet mediated, and stockholders' equity, the owner's leftover slice. Add up both sides, and they match to the dollar. 445 equals 445. They always will, which brings us to why. Here's the secret that makes the equation impossible to break. Every transaction, every single one, has at least 2 effects. Accountants call it the dual effects concept, and once you see it, you can't unsee it. Watch. The company buys a case of Deluxe talking sticks, and that's supplies for $3 cash. 2 effects. It receives supplies so that asset goes up by 3. It gave up cash so that asset goes down by 3. Up 3, down 3, same side. The equation doesn't budge. Now a trickier one, buying on credit. The company orders $4 of referee whistles but doesn't pay yet. That's 2 separate events at 2 different moments. First, it receives the whistles, supplies up 4, but instead of cash, it hands over a promise to pay. That promise is a liability, accounts payable, up 4, assets up 4, liabilities up 4, balanced. Then later, payday for the supplier. The promise disappears, accounts payable down 4, and cash goes down 4 to keep that promise. Both sides fall together, still balanced. 2 effects, every time. Keep that in your back pocket, because we're about to run 10 real transactions through the arbitrator's books, and I want you to catch both effects before he says them. Case number 1, every business needs seed money, and an arbitration is no exception. Those emotional support beanbags don't buy themselves. So Roommate Arbitration Services issued 300 new shares of common stock at a par value of 1 cent a share and sold them to investors for 25 cents each, pulling in $75 in cash. Now watch the dual effects. It received cash, so assets go up by 75. In return, it gave investors ownership. The par value, $3, lands in common stock. The extra 72 investors paid above par, additional paid in capital, assets up 75, the equity up 75. The equation still balances, and not a single dish has been washed yet. Case 2. Business is booming, and turns out roommates never stop fighting, so the arbitrator wants a second location. He walks into the bank and borrows $60, signing a note he'll pay back in 2 years. 2 effects. The company receives cash, assets up 60. But that money isn't free, and it gave the bank a promise to repay, a liability called notes payable up 60. Assets up 60, liabilities up 60. And notice what did not happen. The owner's equity didn't move an inch. Borrowing money doesn't make you richer, it just makes you owe someone. The equation stays balanced and the bank stays smiling. Case 3. Every good mediator needs infrastructure. The company spends $40 cash on new equipment, a soundproof cooling-off chamber, a set of tamper-proof thermostat lockboxes, and a courtroom-grade gavel with real heft. This time, both effects land on the same side, assets. Equipment goes up by 40. Cash goes down by 40. The company didn't get richer or poorer, it just traded one asset for another. Cash became gear. Liabilities and equity, untouched. Balanced. And the thermostat at long last is under lock and key. Case 4. The company's secret weapon is its dispute resolution algorithm, the one that determines with cold mathematical certainty whose turn it was 3 turns ago. To protect it, the company spends $15 cash to trademark it. That trademark is an intangible asset. You can't touch it, but the company owns it and it has value. So intangible assets go up 15 and cash goes down 15. Same move as before. One asset swapped for another. The equation holds, and the algorithm is now legally untouchable. Case 5. Our most complicated yet, so watch closely. The arbitrator opens that second branch. He acquires $10 of land and a $20 building, $30 of new property, but he doesn't pay all cash. He puts down $5 cash and signs a note payable for the remaining $25. Count the effects. Land up 10, buildings up 20, cash down 5, and a new liability, notes payable, up 25. Now the balance check. Assets rose by a net 25, 30 in property minus 5 in cash, and liabilities rose by 25. Both sides move by the same amount. Even a 4-account transaction can't break the equation. Case 6. Instead of buying every location, the company rents, signing leases for $30 worth of satellite mediation pods it can place inside apartment complexes. Under today's accounting rules, the right to use those leased pods is itself an asset, operating lease assets up 30. But signing a lease means promising to pay rent, so the company records lease liabilities to match. $5 due within the year, and $25 due after that. Assets up 30, liabilities up 30. Balanced. The company controls $30 of pods it doesn't technically own, and the equation doesn't mind one bit. Case 7. Payday for the arbitrators is coming, and the company needs cash on hand, so it sells $12 of its short-term investments and collects $12 cash. 2 effects, both on the asset side in opposite directions. Cash up 12, short-term investments down 12. It's a swap. One asset becomes another, so total assets don't change at all. Liabilities and equity sit still. The arbitrators get paid, and the equation never flinched. Case 8. Time to be responsible. The company pays $8 toward that bank loan, and because this is an introductory course, we'll politely ignore any interest. 2 effects. Cash goes down 8, and the liability notes payable goes down 8. A chunk of the promise erased. Assets down 8, liabilities down 8. Both sides shrink together. Paying off debt doesn't touch the owner's equity. It just makes the company own a little less and owe a little less at the same time. Case 9. Remember the co-founder, the one who moved out and allegedly took the good blender? The company buys back $20 of stock from him to end the partnership. Cash goes down 20. That's the clear one. But the other effect is sneaky. Buying back your own shares reduces stockholders' equity. We record it in an account called treasury stock, which brings equity down by 20. Assets down 20, equity down 20. Balanced. The company is smaller, the cap table is cleaner, and the blender is officially gone forever. Case 10. Our finale. The board gets generous and declares a $2 cash dividend to shareholders, but here's the twist. It won't be paid until next quarter, so no cash leaves today. Instead, the moment the board declares it, the company owes that money, a new liability, dividends payable up to. And because dividends are paid out of the owner's accumulated profits, retained earnings, part of equity, goes down too. A liability rises, equity falls by the same $2. Assets don't move at all, and the two sides stay in perfect balance. 10 transactions, stock issued, money borrowed, gear bought, a branch opened, pods leased, investments sold, debt repaid, a co-founder bought out, and a dividend declared. Every single one moved at least 2 accounts. And every single time, no matter how tangled, the equation held. Assets equal liabilities plus stockholders' equity. That's not luck. That's the whole design. Roommate arbitration services still can't tell you whose leftovers those were in the back of the fridge, but its books? Immaculate. Down to the dollar. If your household could use an audit, or you just enjoy watching numbers behave, subscribe. Next time, the income statement, where we finally find out whether suing your roommate is actually profitable. Court is adjourned.